Hello and welcome back to part 3 of this drafting and interpreting financial statements mock walkthrough. So in part 3 I'll be running through task 5, which is on consolidated financial statements, where we can expect to see a consolidated statement of financial position and consolidated statement of profit or loss. So what we'll do now is we'll swap over to the question and make a start. So then, task 5 is worth 30 marks and is about drafting consolidated financial statements. So we can expect to see a consolidated statement of financial position and consolidated statement of profit or loss within this task. So part A, draft a consolidated statement of financial position for Bold plc and its subsidiary undertaking as at the 31st of December 20x1 for 20 marks. So just above that it says the summarised statements of financial position of Bold plc and Per Limited as at the 31st of December 20x1 can be viewed in the references section to the right. So we'll be opening that up very shortly. It also states, note the following: you don't have to use the workings tables to achieve full marks on the task. However, any data that you enter into the workings tables will be taken into consideration if you make errors in the main pro forma. Show any items that need to be deducted as negative figures using minus signs. So all that's saying is just below we've got some workings boxes for goodwill and retained earnings. And if you remember from task 1 and 2, I mentioned that the workings boxes can pick you up a few marks if you make a mistake within the question. They will still look at the workings boxes and potentially award 1 or 2 marks based upon those. If, however, everything is correct within your answer within the main question, then you will get full marks. You don't have to fill out the workings boxes. However, I think it's just good practice to do it anyway, so I would recommend that you do that. So let's open up the references then. So we are working on task 5 part A at the moment, so let's click on that. And we can see that we've got a statement of financial position for Bold plc and Pearl Limited. We also have some additional data just underneath, which we'll be going through as we work through the question. Okay, so our first box is goodwill, and it is one that we have a workings box for. So goodwill format will always look very similar. The only thing that will change is if there is any impairment. So we'll have a look at the question and make a decision as to whether there is any impairment. It doesn't look like it. I can already tell because there's only 3 boxes here and we would need a 4th if there was impairment, but we'll get onto that shortly. Okay, so the first thing that we would enter into our workings box would be consideration. And this is effectively how much the parent company has paid for its share in the subsidiary. Now in this question it states that Bold plc acquired 80% of the issued share capital and voting rights of Per Limited on the 1st of January for 1.5 million. So the consideration, being the amount paid, would be 1.5 million. Remember, these are in thousands, so therefore we only need to put 1,500 in to recognise it as 1.5 million. Now the next box will be your non-controlling interest. Now, the way I do this, and this may just be me, it's just something that I prefer to do, is I actually will enter that in. So I'll enter the non-controlling interest in, but to calculate the figure, I'll actually come back to that. So first I will do the third box, and I'll explain why shortly. So the third box will be your net assets acquired. Now your net assets acquired is the value of the subsidiary at the time at which it was acquired. So it's effectively what they were worth at the point that these shares were purchased, in this case by Bold plc. Now to get that information, we need to go to our additional information. Now we can't get that from the statement of financial position up here because this is as at the end of the financial year, but they didn't acquire them at the end of the financial year. So therefore these figures are somewhat meaningless for the net assets acquired figure because they weren't purchased at the year end, which these figures here are representing. So we need to go to our additional data. So it states that Bold plc acquired 80% of the issued share capital and voting rights of Pearl Limited on the 1st of January for 1.5 million, which was our consideration. At that date, Pearl Limited had issued share capital of 1 million and retained earnings of 640,000. So what this means is that at the time Bold plc acquired 80% of Pearl Limited, their net assets were the equivalent of 1.64 million, which is your share capital plus your retained earnings. So it would be 1.64 million. Now, the only other thing to watch out for when calculating this net assets figure is if there were any revaluations that had not yet been entered into their account. And when I say there, I'm referring to Pearl Limited, so the subsidiary. If there were any revaluations in this additional data that had not yet been accounted for, you would also add that figure, so the revaluation amount, into the net assets acquired. But in this example, we don't have any. So it is simply your share capital and your retained earnings figure. Now, we always show this as a minus because it is deducted from your consideration and non-controlling interest in order to give you the difference, and the difference is your goodwill. So just not taking a huge tangent here, but just a very quick explanation of goodwill. So the goodwill value is the amount that the parent company has paid above what the net assets of the subsidiary were worth. So just to give you some really simple numbers, if, for example, the parent had bought the subsidiary for £1 million and the subsidiary's net assets were £1 million, then there would be zero goodwill, because they've paid for exactly what the business is worth on paper. Now, goodwill occurs when the business pays above what the net assets are on paper. So if I change my numbers slightly and said that a business, for example, paid 1.2 million for a business that had net assets of 1 million, then the goodwill would be 200,000. It's the difference between the net assets figure and what the business paid. Now, the last figure we need to calculate, so just coming back to this question now. So the last figure we need to calculate is the non-controlling interest. And the reason why I calculate this last rather than second is because it is simply using your net assets acquired, and we're going to times that, multiply it, by the percentage that the business did not acquire. So in this example, Bold plc acquired 80%. So the percentage that they didn't acquire, and therefore they do not control, i.e. non-controlling, would be 20% of that business. So to calculate your non-controlling interest, and bear in mind this is at acquisition, so when they purchased it, it would be 20% of your net assets acquired figure. So it would be 1.64 million multiplied by 20%. And that gives you a non-controlling interest figure of 328. Now, the reason we need to take that into account is because this business has paid 1.5 million and the net assets of the subsidiary were 1.64 million. Now, if they'd bought 100% of those shares, then there would be no non-controlling interest. But because they only bought 80%, what you're actually saying is they paid 1.5 million for 80% of their net assets. So we need to take into account the fact that actually, although we paid 1.5 million and the business's net assets were 1.64 million, they aren't getting that 1.64 million. They're getting ownership of 80% of that value, which is where your non-controlling interest figure comes in, because that is showing 20% of the business's net assets that they do not control. Okay, so we now have our goodwill figure of 188,000. So we can now enter that into our consolidated statement of financial position. So next comes the property, plant and equipment figure. So for this one, all we need to do is add our property, plant and equipment for Bold PLC and Pearl Limited. So basically the parent and subsidiary, add the two property, plant and equipment figures together. Just double check as well to make sure that there's nothing in your additional data that would affect these figures. I can see from these that there isn't, and therefore we can simply add the two together. And that comes to 5967. Okay, then the current assets, the same process would take place. So we simply add our parent, so Bold PLC, to our subsidiary, which is Pearl Limited. So 831 plus 142, and then we just need to make sure again that there's nothing in the additional data, which there is something in the additional data for this one. So it states here, including the current assets of Bold PLC and in the current liabilities of Pearl Limited, is an intercompany balance of 38,000. So that would therefore need removing. We cannot have an amount owed between parent and subsidiary within the consolidated financial statements. Therefore, that 38,000 needs removing. So therefore, to get our current assets figure, it would be 831 plus 142 minus 38, which gives you a current assets figure of 935. Okay, so that completes our total assets. Moving down then to the equity section. So share capital would simply be our parent share capital. We do not include the subsidiaries here. So it would simply be our 5,000. Now for retained earnings, we do have a workings box. So I might need to scroll over a little bit here. So retained earnings are made up of the parent's retained earnings and the subsidiaries. However, it is not all of the subsidiaries. So let's just enter these in. So we've got Bold PLC first, and their retained earnings are, let's have a look, 820. So let's enter that in, 820. And then the retained earnings for Pearl Limited relate to the post-acquisition profits attributable to Bold PLC. So the way that we calculate this is we have to do the difference between the retained earnings at the end of the year, so 690, and the retained earnings at acquisition, which was 640. So the difference between the two retained earnings figures, so the profit that was earned throughout the year by the subsidiary, would be 690 less 640, which comes to 50,000. However, we know that Bold PLC are not entitled to that full 50,000 because they only own 80%. So they would therefore be entitled to 80% of their retained earnings. So if the profits they'd earned throughout the year were 50,000 and they were entitled to 80% of that, that would mean that the profits attributable to Bold PLC would be 40,000. So that gives us our retained earnings figure of 860,000. So we can enter that in. Now, the non-controlling interest figure will be made up of two different figures. It will be made up of share capital and retained earnings. So previously, when we were looking at the non-controlling interest within the goodwill calculation that I'm showing you here, we were looking at the figures at the start of the year that were given within the additional data. However, now we're at the end of the year, so we're doing the consolidated at the end of the year. So to calculate the non-controlling interest, it would be your equity section of your subsidiary, so this 1690, multiplied by the percentage that Bold PLC does not own, therefore 20%. So it would be 1690 multiplied by 20%, which gives you a non-controlling interest figure of 338. So that finishes off our equity section. We can now have a look at the non-current liabilities. So that should simply be your non-current liabilities, which are here, add together. So 418 plus 124. which gives you a figure of 542. Now, current liabilities, we would usually just add the two together, but if you remember, we had an adjustment in here where we had an intercompany balance of 38,000 that needed removing both from the current assets, so that would be taken account within your trade receivables, but it would also be in your current liabilities, so within the trade payables. So it needs removing from both. So it would therefore be, to get your current liabilities figure, both current liabilities, so 332 plus 56 plus 56 minus the intercompany balance of 38,000. And that gives you a current liabilities figure of 350. So our last double check is to make sure that our total equities and liabilities equals our total assets, which we can see that it does. It is very unlikely that if those two figures do match up that you've done it wrong. It would have to be an adjustment that you'd missed from both the assets section and within the equity and liabilities section. So it is feasible, but it is unlikely. If they don't match up, then you've definitely done something wrong and you'd need to go back and double check all your figures. Okay, so that completes part A. Let's now move down to part B. So I'm just going to come off the references briefly to be able to read the question out. So part B then, draft a consolidated statement of profit or loss for Flash plc and its subsidiary undertaking for the year ended the 31st December 20x1 based upon the extracts shown above. Note the following: you don't have to use the workings tables to achieve full marks on the task. However, any data that you enter into the workings tables will be taken into consideration if you make errors in the main pro forma. So as was in part A, same thing that I said about I would do it just in case something doesn't go right within the question. You may be able to pick up a couple of marks from those workings boxes. It also states show any items that need to be deducted as negative figures. So we know that cost of sales and operating expenses are both going to be minus figures because they're taken off your revenue. Okay, so let's open back up our references table and go to part B. So we do have two workings boxes. We've got revenue and cost of sales. So we've got the statement of profit or loss for Flash plc and for Power Limited. It states that Flash plc acquired 80% of the issued share capital and voting rights of Power Limited on the 1st of January 20x1. During the year ended the 31st of December 20x1, Flash plc sold goods which had cost $240,000 to Power Limited for $300,000. 1/3 of these goods still remain in inventories at the end of the year. Okay, so we'll need to adjust for those, so that's fine. So let's have a look at revenue first. So consolidated revenue prior to any adjustments would simply be your revenue from Flash plc plus your revenue from Power Limited. So 16,850 plus 5,806, which comes to 22,656. So then our next box down is the consolidation adjustment. So all we need to do in our revenue is take out the full sales value because we would have 300,000 in our revenue figure that related to this intercompany transaction. We know that for the consolidated statements, we need to remove any sales between parent and subsidiary or subsidiary to parent. So all we need to do in our revenue minus 300. So that gives us a consolidated revenue figure of 22,356. Then on to the cost of sales then. So we start off with the consolidated cost of sales prior to any adjustments. So that would simply be your two cost of sales figures added together, which comes to 15,966. And then the next figure is your consolidation adjustment. Now, this is made up of two parts. So we need to take out, firstly, the full 300,000, which was the sales value of the goods made from Flash plc to Power Limited. So we need to first off take off 300. However, the problem that we've got is that we've still got items within our inventory. Now we know that inventory forms part of our cost of sales figure. So not only have we got that 300,000 that would be included within the purchases figure that make up the cost of sales, so we know we need to remove that. We've also got some inventory that remains within our closing inventory figure. So we don't need to remove the original cost. What we need to do is remove the profit, because at the minute that inventory is going to be sat within our cost of sales figure with profit on it that was made between the two businesses, which we cannot have because it's overinflating our inventory figure. So what we need to do is remove any profit that remains within that inventory figure. So to do that, we need to look at how many goods were remaining. So it states here that 1/3 of these goods still remained in inventories at year end. So if 1/3 of the inventory remained, we would need to remove 1/3 of the profit. So to calculate this, we need to first work out the total profit on the sale, which was 300,000 less 240,000. So the profit on the entire sale was 60,000. However, only 1/3 of the goods remain within inventory, and therefore we only need to remove 1/3 of that profit. So if the profit was 60,000, then 1/3 of that would be 20,000. So the full adjustment would be to minus off 300,000, which you're basically taking that out of your purchases figure that makes up the cost of sales, and you're then adding back on 20,000. And the reason we're adding back on 20,000 is because we are reducing our closing inventory by that profit of 20,000. So you might say, well, hang on, if we're removing it, why are we adding it back on? Well, we're adding it back on because by reducing our closing inventory figure, remember that closing inventory is a minus within the cost of sales calculation. So by actually reducing the closing inventory, you are in effect increasing your cost of sales because that closed inventory figure is taken off. Now, I'm not 100% sure whether that will be fully explained in your book or whether it literally just tells you to minus off the full sales value and add back the profit. What I've tried to do there is explain why you do that. So when you're adding it back, the reason you're adding that profit back is the fact that you're actually reducing your closing inventory, which is a minus within the cost of sales calculation. So I appreciate that's quite complicated, and you don't actually, obviously I do want you to fully understand it. However, if you don't, it's not the absolute end of the world. It's not something I would really stress about. As long as you know that you need to deduct the full sales value and add back in any unrealized profits, that will get you the correct answer. I'm just trying to help you to actually piece this together so that you do understand what it is you're doing. So with that in mind, we're minusing 300 but adding back 20. Therefore, the consolidated adjustment would actually be minus 280. So now that we've got that figure in, that gives us a consolidated cost of sales figure of 15,686. And remember, we need to minus that off because we're taking off the cost of sales from our revenue. So that's automatically filled in our gross profit of 6,670,000. So our next box is other income. So we can see we've got 176 and 10. So we just need to add the two together. So other income would be 186. And then the last figure is our operating expenses. So again, all we need to do here is add the two together. So it'd be 3346 plus 870. And that gives you a consolidated operating expenses of 4216. And again, our profit before tax figure is then automatically filled out for us. Okay, so let's just close down our references. So that finishes off our consolidated statements. It is a really big task that, as you saw at the start, it's worth 30 marks. These are very, very tricky to initially get your head around. The only positive, really, that I would say is that they very rarely change in terms of what can be asked. So once you do understand these, it's a very prescribed format and should actually be fairly easy marks in the exam. It's just getting to that point of fully understanding it, I do appreciate, is quite challenging. Okay, so that does finish off task 5. So that does finish off task 5 and part 3 of this video series. One more part to go where I'll be covering tasks 6 and 7. Well, thank you for watching this video and hopefully you have found it useful. And if you do, make sure you hit that like button and subscribe to the channel for more AAT content. Thanks again for watching. I'll see you in part 4.